Imagine a world where your income, every penny you earn, isn't scrutinized by the IRS, where your hard earned dollars don't vanish into the tax abyss. While there were indirect taxes, that was America before 1913. But then, everything changed with a single amendment, the 16th Amendment. Today, taxes are the lifeblood of government, a necessary evil that we're all too familiar with. Income tax, sales tax, social security tax, gasoline tax, capital gains tax, the list goes on. In the 21st century, we're bled dry by a system that seems inescapable. Yet once upon a time in America, such a system didn't exist. From a mere 10% on the lowest incomes to a staggering 37% on the highest, today's tax brackets are nothing compared to history's peaks. Picture this. In 1944, if you made over $200,000, you kept just 6 cents on the dollar. But why? How did we get here? I'm Ryan Sahlberg, a retired Marine Corps officer with tours in Afghanistan and Iraq, and a history major from the Citadel. Join me as we peel back the layers of time, exploring the political fervor, the economic shifts, and the human stories behind the 16th Amendment, the moment when taxation as we know it was born in the United States. Before the 16th Amendment reshaped America's fiscal landscape, the nation's treasury was filled by tariffs and a sprinkle of excise taxes. Imagine the year 1789, when the first tariff bill was signed into law, marking the beginning of an era where foreign trade became the government's cash cow. Excise taxes? They were the minor irritants, levied on indulgences like whiskey, tobacco, rum, and refined sugar. Yet these taxes could ignite rebellion. Take the Whiskey Rebellion of 1791, where farmers in western Pennsylvania didn't just grumble, they took up arms against a tax on whiskey. A tax meant to chip away at Revolutionary War debts. But tariffs, they were the backbone. From 1790 to 1860, these import taxes didn't just fund the government, they were its lifeline, accounting for a whopping 90% of federal revenue. But their purpose was twofold. Firstly, they were the government's wallet. Secondly, they were America's shield against economic domination. Picture this. The United States wasn't just starting, it was struggling to stand. American manufacturing was in diapers, its industries just learning to crawl. Enter Alexander Hamilton. With his report on manufacturers in 1790, he didn't just propose, he envisioned America that could stand tall without leaning on foreign crutches. Hamilton's call for protective tariffs wasn't just policy, it was a declaration of economic independence. Without these tariffs, our fledgling industries would have been at the mercy of European giants. The Tariff Act of 1790 was more than just legislation. It was a lifeline for American businesses, though its rates were modest compared to the future. These tariffs, while necessary, set the stage for a century of economic battles, where every import tax was a move in the grand chess game of American industry. As the years rolled on, tariffs transformed from mere revenue generators to the economic fortresses of a nation. The War of 1812 wasn't just fought with muskets, it demanded economic armor in the form of double duties and an extra tax on foreign vessels, set to expire 1 year after a peace treaty with Great Britain. But New England, with its shipping veins, bled under these high tariffs. Post-war, the Tariff of 1816 emerged as a moderate shield for American self-sufficiency, yet it ushered in a depression that gripped the nation from 1817 to 1824. Not because the tariffs were too lofty, but, as former Speaker of the House James Blaine noted, it was from the fact that it followed the war tariff, and the change was so great as to produce not only a reaction, but a revolution in the financial condition of the country. All forces of industry languished, bankruptcy was widespread. Then came the protective tariff of 1824, a harbinger of what was to become the most infamous tariff yet, the Tariff of Abominations in 1828. Designed to inflate import prices up to 50%, this act was a lifeline for northern industry, but a noose around the South's neck. While the North and Midwest cheered, the South, relying on British cotton trade, feared British retaliation and saw northern manufacturers grow rich at their expense. This economic divide was not new. The South and New England had always squirmed under protective tariffs, while northern manufacturers relished the federal shield against foreign goods. But the Tariff of 1828 was the straw that broke the camel's back, revealing a stark truth. Northern wealth was increasing, while the South was forced to pay more for domestic and foreign goods. By 1833, a compromise was struck, promising a gradual tariff reduction to 20% by 1842. In a speech to the House of Representatives in 1859, Representative Alfred Scales of North Carolina lamented about this time of high protective tariffs, accusing Northern prosperity of being built on Southern sacrifice, their necessities feeding Northern profits. The Tariff of 1846, which Secretary of State James G. Blaine referred to as a free trade tariff, was actually designed more for generating revenue rather than protecting Northern manufacturing interests. The era spanning from 1846 to 1857 was marked by widespread prosperity across the United States, benefiting both the burgeoning manufacturing sector and the agriculture-dominated South. During this time, the U.S. economy was thriving to such an extent that the Tariff of 1857 was enacted to adjust the 1846 Walker Tariff. This legislative change was prompted by federal budget surpluses in the 1850s, and notably, manufacturers did not seek additional protective measures during this period. However, the economic boom was cut short by the Panic of 1857, which persisted through to 1861. In response to this, the Morrill Tariff was introduced in 1861. This new tariff, backed by the newly empowered Republican Party, was significantly more protective, primarily aimed at safeguarding Northern manufacturing industries from foreign competition. As America was gripped in a civil war and brothers fought brothers on the battlefield, the North faced a fiscal dilemma: how to fund this bloody conflict. Enter 1862, a pivotal year where the U.S. government, for the first time in its history, imposed a federal income tax. Incomes over $600 taxed at 3%, and those exceeding $10,000 taxed at 5%. But that wasn't enough to fund this bloody conflict, and by 1864 the rates escalated. Incomes between $600 and $5,000 now faced a 5% tax. Those from $5,000 to $10,000, a 7.5% income tax, and anything above $10,000, a hefty 10%. But an income tax wasn't the only financial weapon. That same year in 1864 saw one of the highest tariffs ever enacted. Average rates skyrocketed from 18% to a staggering 47.5%, a double-edged sword meant to fund the war while shielding Northern industries from foreign competition. Finally, in 1865, the Civil War ended, but the economic policies continued. 7 years later, the income tax was repealed, but those protective tariffs? They stuck around like an unwelcome guest, shaping U.S. economic policy for over 25 years. Post-war, Northern manufacturers, now accustomed to the protective tariffs, argued that their survival depended on it. They dusted off the same arguments that had protected their profits from 1828 to 1846, insisting that without these barriers, American industry would crumble under foreign pressure. In the post-war period, tariffs remained high, and in 1889, the Republicans seized the White House and tightened their grip on both houses of Congress. They promised tariff reform, but what followed was the McKinley Tariff of 1890. This skyrocketed average tariffs from 47.5% to a staggering 60%. John Wanamaker, the former Postmaster General, foresaw this storm when he said, "Very soon the manufacturers will have their way, and we will have to pay much more." This protectionism had an unintended consequence: the birth of trusts, monopolies that strangled the competition, keeping foreign rivals out and domestic small businesses down. While Republicans championed these tariffs, the public's patience waned, potentially costing President Harrison his re-election, and it gave the Democrats a supermajority in the House. As tariffs fell out of favor in the 1890s, whispers of a national income tax grew louder. Enter 1894, when Democrats pushed for the Wilson-Gorman tariff, aiming to dismantle the protectionist fortress of the McKinley Bill. It slashed tariffs on iron ore, coal, lumber, and wool to zero. But by the time it got through the Senate, the bill was watered down, and it preserved the high rates. Yet hidden within this act was a revolutionary clause: a 2% income tax on incomes over $4,000, the first peacetime income tax in U.S. history. But this experiment was short-lived. In the landmark case of Pollock versus the Farmers Loan and Trust Company, Charles Pollock challenged this tax. He argued it was a violation of the Constitution. The United States Supreme Court agreed. In a contentious 5-4 decision in 1895, they declared the income tax to be unconstitutional, branding it an unapportioned direct tax. The Constitution required direct taxes to be apportioned by state population, a rule that this tax ignored. Its ruling, the dream of an income tax in America was buried, setting the stage for a battle that would define the economic landscape of the 20th century. Over the next 15 years, a groundswell of public fervor grew for the national income tax. The people's voice was clear. The time had come for the government to tap into the fortunes of the wealthy industrialists. Many people believed that the manufacturers who built their empires behind the walls of protective tariffs were seen as growing rich at the expense of the common man. While everyday Americans paid their dues through tariffs, these, quote, robber barons, unquote, lounged atop their vast piles of money, untouched by financial burdens. The call for an income tax became a rallying cry, a Democrats' weapon to ensure the federal government could finally reach into the deep pockets of the business elite. Even within the Republican ranks, a divide was taking shape, pitting the old guard of tariff supporters against a rising tide advocating for the income tax policy. In 1909, a pivotal moment arrived when Senator Norris Brown of Nebraska proposed an amendment to the United States Constitution. His initial draft declared, quote, "The Congress shall have power to lay and collect direct taxes on incomes without apportionment among the several states according to population," end quote. But as this amendment navigated through the Senate Finance Committee, it underwent a transformation. It emerged with a broader stroke, quote, "The Congress shall have the power to lay and collect taxes on income from whatever source derived, without apportionment among the several states, and without regard to any census or enumeration," end quote. Why this shift? No one at the time could say for certain. Yet, this amendment struck a chord, resonating deeply in the South and the West. For years, the South had felt the pinch, watching as Northern manufacturers prospered at their expense. Now here was a chance for a justice, a federal income tax, a tool to redistribute wealth from the idle rich to the federal coffers, promising a fair deal for all states in the Union. Still, the amendment faced formidable resistance, primarily from the northeastern states. Sereno Payne of New York and several other representatives thought that an income tax should only be used in a time of war. Congressman Ebenezer Hill of Connecticut, he also worried that the income tax could be levied unfairly on constituents in the poorer states. But it was Congressman Samuel McCall of Massachusetts who delivered the most chilling prophecy. In a speech that seemed to peer into the future, he warned Congress, quote, "While they say they desire this for a time of war, we see it today in times of peace, an attempt to exercise this power to its utmost extent. And why not, then, limit expressly to time of war? Why not preserve the limitation upon the power of the central government? Why drag every governmental power to Washington so that a vast centralized government may devour the states and the liberties of the individual as well? This amendment should be more carefully considered than it has yet been considered." McCall continued to paint a bleak picture. It is not primarily to raise money for the state, but to regulate the citizen and to regenerate the moral nature of man. You are creating here an ideal condition for corruption and the political jackade of the future to levy blackmail. McCall's words foreshadowed potential abuses of an income tax. We'll delve into the opposition more, but it's clear the amendment stirred unease among some in Congress, with many believing it should be a wartime measure only. On July 12, 1909, after a 5-hour debate, the House passed the bill with an overwhelming 318 to 14 vote, one member voting present and 55 absent. The Senate immediately followed suit, unanimously passing it 77 to 0. Now the gauntlet was thrown. Could 3/4 of the states ratify this amendment to reshape the United States Constitution? Alabama charged ahead. They were the first to ratify just a month after Congress passed the amendment. Soon, Kentucky and South Carolina would join Alabama in early 1910. By July of that year, the tally stood at 8 states in favor, all but one from the South, versus 8 opposed. In January 1911, Ohio ratified the amendment, making them the 10th state to do so. Resistance was clear, though. New York, Rhode Island, Virginia, Massachusetts, and Louisiana stood firm against it. By March 1911, the count climbed to 26 in favor, while 11 states, including Arkansas and New Jersey, either rejected or ignored the amendment. With Arizona and New Mexico on the cusp of statehood, the magic number was now 36. However, there is a flaw in the ratification process. Once a state ratifies it, its decision was locked. But those that rejected it, they could later flip their stance. This meant that states could potentially change their minds in favor, but not against. While Kentucky's legislature was one of the first states to ratify the amendment, Kentucky Governor A.E. Wilson came out strongly opposed to the amendment. Wilson, a Republican governor in a heavily Democrat state, argued that There is a fallacy that with the federal income tax, it will be the Rockefellers and the Carnegies and other multimillionaires who will pay for the running of the government. The poor man does not regard his wages or salary as income. The 16th Amendment gives Congress the power to levy a tax on profits of farms, factories, stores, on the earnings of all men and women, in whatever work or calling, and on all other kinds of income. He went on to say that, under our present system of taxation, it is the mass of people who bear the burden, not the multimillionaires. Under a federal income tax, the same condition would exist. His concerns were manifold. He feared the amendment would drain sovereignty from the states, counties, and cities. The federal government was already taking a large sum of money from Kentucky and its citizens, but now they're going to take even more? But his most ominous prophecy was yet to come. He said, if you give Congress the right to tax and Congress will use it, there are hundreds of men in public life wormy with schemes to spend money and provide jobs for henchmen. One man is thinking irrigation, another of a transcontinental railroad in San Francisco, another of an Appalachian Reserve, another of a national park in the White Mountains. Every new chance to raise additional revenue is another opportunity to get one of these schemes through and bunches of jobs with them. Wilson's words resonate with chilling accuracy today, where federal spending often feeds bureaucracy and contracts for the few. He also critiqued the amendment's broad phrasing, from whatever source derived. This, he warned, would allow the federal government to tax even state officials' salaries and municipal bonds, further eroding state power. If this tax is for war, say so in the amendment, Wilson argued. His vision of potential abuse tragically unheeded. His warnings went largely ignored, and his re-election bid unsuccessful, leaving Kentucky, and perhaps the nation, to navigate the consequences of his unheeded counsel. Throughout 1911, several states ratified the amendment. Maine was the first in late March, followed by Tennessee. Arkansas, initially a naysayer, dramatically switched sides, pushing the count to 25 for 10 against. But there was still some state opposition. Massachusetts rejected the amendment in May. Yet by July 1911, the momentum was undeniable with 31 states in agreement, New York's reversal being a turning point. Then silence for 10 months, as nothing moved. The fire was rekindled in April 1912 when Arizona, a newly part of the Union, voted to ratify. By year's end, 34 states were on board. 1913 dawned with West Virginia flipping its stance. The nation held its breath, needing just one more state. That moment arrived on February 3, 1913, with Delaware's ratification. But the story didn't end there. New Mexico and Wyoming ratified on the same day, and New Jersey followed the next. The 16th Amendment was now constitutional, allowing the federal government to impose an income tax. This wasn't just a change in tax policy, it marked the first constitutional amendment since 1870, when the 15th Amendment ensured voting rights for all, regardless of race. The landscape of America was forever altered. In 1913, the political landscape of America was ripe for upheaval. Enter Woodrow Wilson, who swept into the presidency with just 42% of the vote, thanks to a split in the Republican ranks when Teddy Roosevelt challenged the incumbent Taft, fracturing the party's support. The Democrats, now in control of both the White House and Congress, were eager to enact their vision. Wilson, a proponent of progressive taxation, championed the Revenue Act of 1913. This act wasn't just a piece of legislation, it was a transformation. It slashed tariffs from 40% to 27% and placed essentials like raw wool and coal on a free list, making them tariff-free. But the real game changer was the income tax, a concept dormant since the Civil War. Now anyone earning over $3,000 faced a 1% tax, with the wealthiest, those earning over $500,000, topped out at 7%. Initially, it seemed like the tax would only nibble at the rich, affecting just 2% of Americans. This tax was more than just numbers. It was a promise that the wealthy would bear more of the nation's financial burden. But as the clouds of World War I gathered, that promise would be tested. By 1916, with the Revenue Act of the same year, the tax landscape shifted again. The bottom rate doubled to 2%, the top soared to 15% for incomes over $2 million, and the 7% bracket now started at $100,000. As America plunged into the Great War in 1917, taxation became a weapon. Rates skyrocketed from 2% to a staggering 67% for those earning over $2 million. The war's demand for funds was insatiable, pushing tax collection from $809 million in 1917 to $3.6 billion in 1918, financing a third of the war's cost. Meanwhile, a quiet revolution occurred in 1913 with the birth of the Federal Reserve. This institution would slowly but surely alter the value of the dollar, setting the stage for inflation and an ever-widening tax net as incomes grew. By 1918, with the highest earners now paying up to 77% on incomes over $1 million, the income tax had morphed from a gentle nudge to a forceful push, transforming not just how America was governed, but how it envisioned its economic future. This was more than policy, it was the reshaping of a nation's financial soul. Post-World War I, America's tax story took a turn for the lighter, with rates reaching a low of 25% for top earners by 1925. This era of relative tax calm lasted through the Roaring '20s. But as the Great Depression cast its shadow, the government sought to jumpstart the economy, not with policy finesse, but with fiscal might. Enter the Revenue Act of 1932, where taxes didn't just rise, they soared. The top bracket hit 63% for incomes over $1 million, with hefty increases across the board. Imagine earning over $100,000 and suddenly facing a 56% tax rate, up from 25%. Despite this, the economy remained stubbornly depressed, taxes climbing as high as 79% during the darkest days. As World War II loomed, taxes became a weapon of war. With America's entry, the government crafted what they audaciously called the victory tax in 1942. This was tax policy at its most progressive, with the top rate at a jaw-dropping 88% for incomes over $200,000, and even the lowest earners now taxed at 19%. By 1945, as the war raged on, the top tax rate climbed to 94%, a testament to the government's desperate need for funds. This era marked a stark transformation, from a time when only the wealthiest paid taxes to one where 90% of Americans were filing returns. The 1950s maintained this trend, with the top rate stubbornly at 91%, only beginning to ease in the 60s. Over subsequent decades, tax brackets gradually shifted lower. By the 90s, the top rate oscillated between 30 and 40%, reflecting a less punitive, though still significant, tax environment. But taxes weren't the only economic lever. Tariffs, though overshadowed, played their part. The Fordney-McCumber Act of 1922 and the Smoot-Hawley Act of 1930 pushed tariff rates up. But post-World War II, America embraced free trade, with tariffs dropping to a modest 1.4% to 2.9%. This tax journey through the 20th century isn't just about numbers, it's about how America, through economic highs and lows, war and peace, sought to balance prosperity with fairness, weaving a complex tapestry of fiscal policy that continues to define our national identity. Before 1913, America's treasury relied heavily on tariffs, with a sprinkling of excise taxes. Occasionally, when wars loomed, like the Quasi-War with France or the War of 1812, the government dipped into land taxes, but tariffs were king. These weren't just revenue tools, they were shields for the fledgling American industry, protective by nature, guarding against the might of foreign markets. Picture this: the Tariff Act of 1790, America's first protective tariff, was modest, but it set a precedent. It's like putting training wheels on a new bike, necessary at first, but eventually you've got to let go. By 1846, with the Walker Tariff, America took a bold step towards free trade, slashing rates to about 22%. Critics like former Senator Charles Schurz predicted doom. They warned of American industry collapsing, workers jobless, and foreigners taking over markets. But as history would tell, this fear was unfounded. James G. Blaine, a proponent of high tariffs, later admitted that the post-1846 period, not only did the country see a surge in revenue, but prosperity also flourished. Money flowed, speculation soared, and the U.S. economy boomed. American manufacturing didn't just survive, it thrived. Schurz noted how competition spurred innovation, not destruction. Manufacturers, once coddled by protectionism, adapted and excelled. This era wasn't just about survival, it was about thriving, with steady profits and agricultural growth. By 1856, the industry was so robust that protective tariffs weren't even a whisper in political circles. There's a lesson here. When you lean too much on protection, like a crutch, it can create a dependency. But when manufacturers stood on their own, embracing sound business practices, they not only competed, but they dominated. Interestingly, there were times when the federal coffers overflowed with surplus from these tariffs. The years before the 16th Amendment, the government was actually wondering what to do with too much money, a stark contrast to the fiscal strategies that would follow. The ratification of the 16th Amendment might just be the silent assassin in the ongoing saga of state sovereignty. Since the Civil War, states' rights have been on a slow, steady decline. Let's revisit two critics of this change, Representative Samuel McCall of Massachusetts and Kentucky Governor A.E. Wilson. McCall, a vocal opponent, foresaw a future where the federal government would burgeon into a leviathan devouring states' rights and individual freedoms. He questioned, why drag every governmental power to Washington so that a vast centralized government may devour the states and the liberty of the individual as well? Before 1913, taxing income was a state affair. Since then, the federal tax has eclipsed state taxes, relegating them to afterthoughts. The federal government, wielding its fiscal might, sometimes even blackmails states. Remember Louisiana in 1996? They dared to challenge the national drinking age, only to backtrack when federal highway funds were threatened. McCall also believed the amendment wasn't just about revenue, but about controlling citizens' behaviors. Fast forward to 2022, the U.S. tax code spans 6,871 pages, ballooning to 75,000 when including regulations complex, opaque, and burdensome. The IRS, with its vast reach, has occasionally been wielded like a political weapon. Governor Wilson, with his keen foresight, warned that the tax wouldn't just hit the Rockefellers and Carnegies. Initially, only the elite paid, but by the 1940s, 90% of Americans filed returns. Today, around 60% pay federal income tax, with many of the non-payers supported by welfare, ironically increasing the tax burden on others. Wilson predicted this shift, seeing how it would empower a central government eager to expand its reach. Give Congress the right to tax and Congress will use it, he warned. Congress is greedy for money, extravagant in spending. There are hundreds of men in public life, wormy with schemes to spend money and provide jobs for henchmen. Every new chance to raise revenue is another opportunity to get one of these schemes through, and bunches of jobs with them. Wilson accurately predicted the bureaucracy's growth and spending spree. Today, the federal workforce tops 2 million, and that's excluding military. A stark contrast from the 380,000 in 1910. Paired with the Federal Reserve, which I will delve into in a later video, the income tax has fueled federal spending, further diminishing states' power. In essence, while the 16th Amendment started with noble intentions, moving away from tariff-induced monopolies, it morphed into a tool that reshaped the balance of power in America, just as Wilson and McCall had feared. So how do you feel about an income tax versus a tariff system? Could tariffs work without leading to protectionism, or should we maintain the current income tax structure that we have?